Welcome, ladies and gentlemen, to our regular 6-minute strategy. In this episode, I've taken a step back from our regular market reviews and looked at 5 profound changes in the economy over the last decade and considered what they mean for investors in the years ahead. The first is the aftermath of the COVID pandemic, which saw not only the biggest quarterly decline in GDP ever recorded, but then a rapid resumption of inflation after more than a decade of near stable prices. Secondly, oil prices were remarkably subdued for most of the last 10 years, in part because of surging US domestic production, but also because of a broad absence of military conflict. Today, with Pax Americana under threat in Ukraine and the Middle East, can this last? Our third challenge is that budget deficits that exploded during the COVID era still remain stubbornly high. Could fiscal rather than monetary policy now be the key challenge for investors in the years ahead? Fourth, the last decade has seen a steady slowdown in the engine that has led global growth for more than 20 years, namely China. What does this mean for markets? Fifth and finally, the last decade saw a growing realisation of the challenges and risks of climate change. Yes, we've missed many of our targets, but the spending in the years ahead still looks to be one of the biggest capital programmes ever undertaken. In the slides ahead, we'll consider these extraordinary trends and the likely portfolio positioning needed to meet them. So let's begin by looking at some of those original COVID charts we used to consider and seeing how they're updated today. In the left-hand panel, I'm showing gross domestic product for the major world economies, indexed at 100 in 2019. And you can see that extraordinary decline and recovery, probably the greatest on record. And you can also see that all the major economies are now larger than they were pre-COVID, the US by an extraordinary 7%. In the right-hand panel, of course, the other fallout from the crisis was disrupted logistics and supply chain and huge changes in spending habits. This drove up global inflation. As you can see on the right, the central bankers are being reasonably successful in squeezing the numbers back to target. That red line, the European numbers, particularly impressive this week, falling from 4.3% to 2.9%. But squeezing that last 2% out, getting back to target for central banks, I think is going to be hard. And by the end 2025, we expect the UK to be 2.7% and the US at 2.5%. Nevertheless, that progress is enough to potentially underpin bond yields. And with yields around 6% today for UK corporates and 5% for US Treasuries, you're beginning to have opportunities to build a well-priced bond portfolio. The second phenomenon of the last decade was remarkably subdued oil prices. You can see that in the left-hand panel for real oil prices adjusted for inflation in that shaded panel. What you can see happen was that while there were relatively small skirmishes between Arab and Israeli in Palestine, there was no major conflict which disrupted supply, as you saw back in the Arab embargo of 73, the Iranian Revolution, or the Iraq War. The question for us today, though, is as the crisis now between Hamas and Israel escalates, will that draw in other players? Well, our bad outcome draws Hezbollah, Syria, Yemen, all threatening to disrupt supply, pushing oil perhaps up above $100. A really ugly outcome has a conflict broadening to draw in Iran, Egypt, Jordan, and really begin to hit OPEC's spare capacity. Now, we're not at those bad scenarios yet, and we still think the odds are this crisis remains contained. But begin to prepare for the downside and particularly introduce some portfolio insurance and higher cash levels across portfolios. Challenge 3 from the last 10 years is the gradual pivot from monetary to fiscal policy as the leader in terms of economic impact. On the right-hand chart, you can see QE gradually unwinding as the curtain closes, and those huge spending programs of the central banks in the COVID years beginning to go into reverse. And that, of course, means more bond supply. At the same time, on the left-hand panel, you can see an explosion in budget deficits. Yes, in 2020 and 22, the major economies were spending 4 to 5 trillion in deficits. That's come back now to more like 2 to 2.5 trillion, but that's still more than double the level that they were running pre the pandemic. So we've got our bond supply coming both from central banks unwinding their balance sheets and treasuries spending more, particularly the Biden White House. What does this mean? Well, it's good for growth. It was particularly powerful for the UK-US this quarter, but also it's a threat to underlying bond yields. And as we indicated earlier, we're seeing value there, but we're still being cautious because supply issues in bond markets may be disrupted. The fourth phenomenon, of course, which has been a key for all of the past decade, is China as the engine of global recovery in so many crises. Looking today, though, the trends that began a few years ago are worrying. Consumer price inflation at zero, producer price inflation negative for much of the last few months, suggest a drift towards Japanese-style deflation. And of course, the property market is still a huge problem, and the legacy liabilities of many of the property giants suggest that this will go on for some time yet to come, almost a Japanese-style deflation. So we're cautious still on China equities, and on Greater China returns from asset markets. So another trend that seems to be interrupted in the years ahead. Fifth and finally, as we look back at the last decade, the realization of the potential downside from climate change if we delay transition or indeed take no policies at all now looks unsustainable. And we can see the sort of declines in GDP that might be possible. On the right-hand chart, though, look at the future climate finance necessary to maintain that 1.5 pathway, a potential 6 trillion opportunity in electrification, smart buildings, transport and agriculture, one of the great capital opportunities we've ever seen. Now, it's fraught with difficulty, as we've seen in offshore wind, as we've seen in solar panels. But the opportunity for big industrials, well priced today, to re-rate on climate demand is for real. So I hope that's helped you cast your eye back 10 years ago, remember some of the trends that have been forming, and see what that means for portfolio strategy today for long-term thematic investors. Thank you.